When two or more people go into business together, often the simplest type of business organization they can form is a partnership. But what actually constitutes a partnership, and how is the partnership and its partners taxed? This video will attempt to answer some of those questions. I'm the Tax Geek, and here are partnerships, oversimplified. The first question we need to answer is, what is a partnership? A partnership is formed whenever two or more members carry on a trade or business and share the income, expenses, profits, or losses from the activity. To be a valid partner, each partner must contribute money, property, labor, or skill. The partners must have some sort of agreement as to the role each member plays in the partnership and how each partner shares in the income and expenses of the partnership. This agreement can be a written, formal agreement, or it can be an oral understanding among the partners. But a partnership can also be formed by what is called conduct of the parties. This is where there is no intent of the parties to create a partnership, but their very actions constitute the definition of one. For example, Scott produces YouTube videos, and he induces his friend Alan to make animations for the videos. Instead of paying Alan, Scott promises Alan a share in the revenue from the videos in exchange for his services. Scott and Alan are two members who carry on a trade or business. They agree to share income, expenses, profits, or losses, and each contributes money, property, labor, or skills to the activity. Through their actions, Scott and Alan have created a partnership, even though that might not have been their intention. However, merely co-owning property in and of itself does not create a partnership. In this example, Pamela and Paula are sisters who purchased a vacation home together for personal family use. They share the upkeep expenses of the home. Even though they each contributed money to purchase the home and share in the expenses, they are not engaged in a trade or business, and therefore Pamela and Paula do not have a partnership. And not just individuals can be partners in a partnership. Other entities, such as trusts and estates, S corporations, or even other partnerships can be partners. A partnership is an entity that is separate from its owners. As such, it has its own tax identification number in the form of an employer identification number and files its own information return on Form 1065. But the partnership itself doesn't pay taxes, except in very unusual situations. Instead, the partnership is what is called a pass-through entity. The income and expenses of the partnership are divided among the partners using Schedules K1, and each partner reports his or her share of the income or loss of the partnership, usually on page 2 of Schedule E, although partnership items on the K1 can show up in many different places on Form 1040. For more information on the K1 itself, check out this video on K1s that can be accessed by clicking the card above or the link in the video description. Partnerships can have two types of partners: general partners and limited partners. General partners are partners who materially and actively participate in the day-to-day operations of the partnership. They have unlimited liability for the debts of the partnership. The ordinary business income for a general partner is subject to self-employment tax and is considered to be earned income for the purposes of computing earned income credit, additional child tax credit, and maximum IRA contributions. If a general partner has a loss from the operation of the partnership, that loss can usually be used to offset other income the partner may have. A limited partner, sometimes referred to as a silent partner, has an ownership interest in the partnership but does not participate in the day-to-day operations of the partnership. A limited partner is only liable for the debts of the partnership up to the amount the partner invested. Income from the partnership is not subject to self-employment tax and is not considered to be earned income. Being a limited partner is considered to be a passive activity, and as such, partnership losses can only be used to offset other passive income, such as rental income or income from other limited partnerships. Any losses that cannot be used to offset other passive income carry forward and can be used to offset future passive income. These carry forward losses are recorded on Form 8582, a detailed explanation of which is definitely a story for another time. Since we have two types of partners, we also have two types of partnerships: a general partnership that consists entirely of general partners, and limited partnerships, which consists of both general and limited partners. All partnerships, both general and limited, must have at least one general partner. But what about LLCs? How do they fit in? As a reminder, an LLC, or limited liability company, is an entity formed under state law by one or more members that provides limited liability for its members. LLCs are generally only recognized in the states they are formed, unless the LLC is registered in other states. The liability of all partners in a partnership formed under an LLC is limited to the amount they have at stake in the partnership, not just the limited partners. All multi-member LLCs default to partnership treatment in the eyes of the IRS, unless the LLC elects to be treated as a corporation. Rather than be treated as a partnership consisting of just two spouses can elect to be treated as a qualified joint venture. The couple must file jointly, and each spouse prepares separate Schedules C and SE, dividing the income and expenses of the venture between them however they like. A qualified joint venture cannot be an LLC. If the couple does business using an LLC, they must file a conventional partnership return. Special consideration must be given to partnerships among close family members. A family member partner must be demonstrated to be a bona fide partner. They must have full ownership of their partnership interest and must have an unencumbered right to sell that partnership interest to anyone. A partnership interest can be given to a family member without the family member being required to provide money, property, labor, or skill to the partnership, as long as the partnership interest meets these criteria. And that's the basics of what makes a partnership and what roles partners can play in the organization. Forthcoming videos will delve into the tax implications of being a partner, as well as filing the partnership return itself. Subscribe to the channel and click the bell to be notified of these videos as soon as they come out. Additional information and resources on partnerships can be found in the video description. Please like the video if you found it informative, and share it with anyone else who could find it useful. And as always, your questions, comments, and suggestions are always welcome in the comment space below. Thanks for watching, and I'll be back soon with more of Your Taxes Oversimplified.